Welcome back. Let's focus on Mahindra & Mahindra Financial Services. Well, they reported a rather good operational performance in the past quarter. And in addition to that, they're looking at a rights issue. First up, though, let's get in the management. We have Mr. Ramesh Iyer who joins us. Thanks so much, Mr. Iyer, for speaking to us. Well, give us a quick update in terms of the total book. How much of it is under moratorium? I believe it's closer to around the 45-50% odd. And if you could give us a sense of how much of that is from the tractors division and what's the outlook going ahead? How much do you see it come down in the next few quarters?
So it's important to note when we started the moratorium, that's sometime in April, it was upward of 70 odd percent, 75% or so. But during this period, we have seen more than 40-45% of the customers have actually repaying their installments. So that's what has brought down the customers in moratorium to the level of 40-45%. Interestingly, tractor is even much lower. Around 52% of the customers took moratorium. 40% of them are paying. So they have gone actually close to 30% of the customers now in moratorium. As far as the overall book is concerned, we have about 18% or so, or close to 20% of it in the tractor. And I would assume even in the moratorium category, it will be similar. But the tractor customers are actually telling us that they don't need 90-day moratorium. They are looking at a 30-day kind of a moratorium because they expect their cash flows to improve and come in and they want to repay. So that's the kind of situation. And on the ground, we definitely see collections improving. April over May was double. May over June was double. So clearly, we see the farm cash flows in rural holding up, and that's one root cause of good repayment and good recovery.
Hi, Mr. Iyer. Good afternoon. About this rights issue, the one question that sort of troubling everybody is they want to know why the pricing is so low. Why such a deep discount?
No, so let's fundamentally be clear. Why are we first raising capital, right? So I think the reason for raising capital is we do see the rural story turning around, buoyancy returning, post-October things to become even better. And clearly, with the focus of government towards rural, we see infrastructure story opening up and the farm cash flows are holding up. So we do see growth coming back. And, as a resemblance, if you look at 2010-2014 period, we saw a similar situation of both the cash flows doing well, which will drive growth. We expect 2021 to 24 to be a similar kind of a story. So therefore, the capital raise and therefore the format that we thought was right issue to be the right format. And my request would be don't look at the price from a discount perspective. Nobody gives 70% discount or 80% discount to the market. So it's not a discount. There is a logic very different from the discount to this. This is our 25th year. We are in the silver jubilee year of our operations. And we were kind of mulling on what's the best way to compensate our shareholders. And we thought this is one best way of thanking them for being with us for all these periods of ups and downs. And therefore, we thought, why not give them at a price at which every shareholder could participate? So the simple logic is our way of thanking the shareholders and therefore an attractive price for them to be able to participate. And there's nothing more than that to this price. So therefore, my request is don't look at it from a discount to market.
Wow, that's very generous, Mr. Iyer. But would M&M look to pick up the rights shares that are unsubscribed? I mean, how much money do you think they're ready to bring?
No, so I think if you look at their resolution which they have sent to the stock exchange, talks of covering it for the full. So I don't think there is any issue from how much does M&M want to put in or otherwise. My point was that, make it absolutely friendly to shareholders so that they can participate. So from an M&M point of view, I think the resolution talks of both unsubscribed and any additional portion that they have to subscribe beyond their percentage of what their eligibility is. The resolution talks of that they would pick it up.
So, Mr. Iyer, what you're trying to tell us is that the promoter, that is Mahindra Group, is going to be subscribing fully to this issue, right? Is that correct?
Yeah, so let's say if they are 51% today, for sure they will subscribe to that. And the resolution talks of if there is any unsubscribed portion available, or they are willing to put in that additional funds. That's the resolution.
Okay, all right. It was a little baffling to see such a big discount. One would have wondered that whether or not you were a little bit jittery in terms of demand, but you're saying that the promoter will be participating to the extent that they hold, that's 51%. And you're saying not to look at the price. So for the time being, we'll take it, and it appears the stock market as well is taking more into account your operational performance. So a couple of questions on that front then. Your gross NPAs for the last quarter, I think it came in at the highest we've seen in the last 8 quarters or so. What is the trajectory with regard to your gross NPAs from year on? It's at around 9.19% or thereabouts. And also, I understand that you're looking at reducing some kind of your operating cost. So what would that reduction be if you could quantify it?
Yeah, so very clearly, the gross NPA, one must always consider the environment around before we can say it's high or low. And that's the reason we have also taken an overlay provision. And actually, if you look at the net NPA, it's lower than what was in March. And typically for a business model like ours, the rural cash flows tend to improve only from the third and the fourth quarter. And therefore, we are very happy and comfortable that in this quarter, the leap of NPA is not very high. But of course, one has to consider that there was a moratorium parallelly coexisting. So for us, going forward is concerned, as I said, we saw phenomenal improvement to collections, even from moratorium accounts in the first quarter. And the trend seems to be the same. July is already reflecting the collections to be even better than June that we saw for the first 10, 12 days. So we are very confident and comfortable that the cash flows are holding up. Farm cash flow is doing pretty well. Post-October, you would see sentiments turning even more positive, as subject to, of course, the COVID situation doesn't deteriorate and reach towards rural. Currently, they are very insulated. And that should lead to a good correction in an overall asset quality as we lead into March. So far as the cost rationalization is concerned, we have been saying this for the last couple of quarters. We have taken very focused action around certain line items. But one guidance on the current numbers is there are some one-timers in this, in the sense that because of low operating actions out there and lower volumes, etc., the traveling and conveyance as well as commissions to dealers, etc., would definitely be lower because they are variable, directly connected to the volumes. So we shouldn't look at that they would be repeating every quarter the same way. Nevertheless, there are other line items like, the branch rent, the security services, the BPO services we use, the advertisings that we normally do, all kinds of things we have looked at line by line. We have used digital extensively. That has brought down the cost of collection. Put all of this together, for sure, we would see a 20% reduction to cost over previous year, while currently it's much higher. Some of this will kind of return back. We have also taken few actions on the people front. We have moved about 5% from our fixed cost to variable cost on the people front. We're not recruiting new people in this difficult time, so that by itself will not have any escalation on the people cost. So put all of this together, if our cost to asset was around 2.8 kind of a number, it started climbing down, and we believe that by March we can reach something like a 2.5 type numbers, and we have taken a very aggressive target to move it down to 2% over a period of time.
Okay, Mr. Iyer, sorry, I'm going to go back to the rights issue for a moment. I wanted to just get a sense of what is the feedback from institutional investors, if you might have spoken to them, like for, say, example, mutual funds. And also, how much will your tier 1 rise to post this bout of fundraising?
No, so, as far as talking to investors, institution or mutual fund, we were talking to them pre the price was announced. And of course, we didn't check with them on the basis of price, but they were all very happy and comfortable. And I must tell you that 2006 is what this company listed. And if you look at the list of shareholders from then to now, we have not had too many of them leaving us. Yes, people have maybe added to some, or some have reduced their stake, but nevertheless, most of the shareholders have stayed with us. And I'm sure all of them are very interested in participating. And that's the feeling that we got even when we were talking to them pre the price was announced. So far as the capital adequacy is concerned, it should move it up by another 2%. We are currently 17, will go up to 19 odd percent. And the next 3 years, as I said, we look at consuming it through growth. And we have always believed to stay much ahead of the RBI requirement. And if you look at even historically, whenever we have raised capital, we have raised to be ready for the following 3 years. So I think this capital should do us good for the next 3 years growth requirement. Plus we have our subsidiary in the rural housing, which also consumes capital, and it's 100% sub. So as their growth returns, we may also invest in that business, a part of this.
Final question, Mr. Iyer. What is the current cost of borrowing? And if you would give a sense what it was, say 6 months ago?
So two ways to look at it. Anything fresh that we have borrowed in the last month or so, we've been able to get it at 6.65, sub 7% for sure, from most of the borrowing that we've done. Added to the current level of kitty that we have, the average cost drops to below 8% or around 8%, which used to be at least about 60 basis point higher than that before. So there is a correction that we have seen of around 60, 70 basis point to the overall average, whereas the current borrowings have shown a steeper fall from there.
All right, Ms. Iyer, we'll leave it at that. Thanks very much for joining in and for explaining the most important clarification, of course, coming as far as the rights issue is concerned, saying that it's not a deep discount to the market because it's the silver jubilee year, the 25th year. It's sort of a give back to the investors. With that, we'll take a quick break. On the other side, a quick tech check is lined up with Prakash Kaba and lots more on the market. Stay tuned.